On Friday, the Labor Department reported non-farm payrolls surged well above forecasts. Headlines strong enough that Seeking Alpha ran the headline, "Non-farm payrolls surge rewrites Fed outlook. Rate cuts pushed into question." The White House moved fast, claiming the surge proved rising productivity and argued the Fed should cut rates anyway. Bond markets didn't buy it. The 10-year yield climbed to 4.35%. Rate cut expectations got pushed back. Then, on Monday, Goldman Sachs published a finding that stopped traders mid-scroll. AI is eliminating a net 16,000 U.S. jobs per month, not a projection, an existing trend, measured over the past year. Goldman economists Elsie Peng, Pierre Francesco May, and Jessica Rindles put precise numbers to it. AI substitution is wiping out roughly 25,000 positions monthly, while augmentation adds back only 9,000. The net loss is 16,000. Every month already happening. 2 data points from the same week, a payroll number that beat forecasts, a Goldman paper showing AI eats 16,000 jobs monthly. At first glance, they point in opposite directions. One says the labor market is strong, the other says it's quietly hollowing out. Here is what connects them. The ISM Services Report, also released Monday, showed the services sector holding at healthy headline levels, consistent with GDP growth around 2.5%, economists noted. But buried inside the ISM print, the employment subindex dropped sharply in March. Businesses are still ordering services. They are not hiring the people to deliver them. That pattern is exactly what Goldman's decomposition describes. AI substitution doesn't show up as mass layoffs. It shows up as hiring freezes, as roles eliminated quietly when someone leaves, as entry-level positions that never get posted. The headline payroll number captures people still in seats. It does not capture the seats that were never refilled. This is why the White House argument, strong payrolls equal rising productivity, therefore Fed should cut, contains a buried flaw. If part of the productivity gain is AI replacing workers, rather than making workers more productive, the labor market is tighter on the surface and looser underneath. Goldman's second paper makes this explicit. Workers displaced by technology spend years fighting to recover wages. They show up in the unemployment rate only after exhausting options. They don't show up in the headline payroll number at all. The Fed is trying to read the labor market through payroll prints. But if AI-driven substitution systematically separates headline strength from underlying demand, the Fed's primary labor market gauge is reading the ceiling while the floor is dropping. The Iran war adds another layer. The ISM noted that businesses cited the Middle East conflict and elevated energy costs as reasons for caution. Brent crude is trading near $110. The services jobs component drop in March happened while companies were still weighing oil at $110 and a war in its 6th week. Goldman's AI displacement is compressing from one direction. Energy-driven margin pressure is compressing from another. The payroll headline captures neither. The weight of evidence here leans toward the Fed staying on hold longer than the market currently prices. But the condition matters. If the payroll strength in the headline is real and broad-based, cuts are genuinely off the table into summer. If April's ISM employment subindex drops further and the Goldman displacement trend shows up in initial jobless claims, which historically lag AI-related job losses by 2 to 3 quarters, the surface strength cracks. When it does, rate cut expectations could reprice fast in the other direction. The recovery scenario is real. A ceasefire in the Gulf is apparently being negotiated, a 45-day framework according to Axios. If oil drops from $110 toward $85, margins recover, business hiring hesitancy fades, and the jobs component in May's ISM rebounds. In that scenario, the payroll headline and the underlying trend converge, and the Fed reads a clean signal. Markets rallied Monday precisely on that hope. The S&P 500 closed at 6,611, up 0.44%. The benchmark to watch, April's ISM Services Employment Subindex, released in early May. If it recovers alongside a ceasefire, the hidden link between AI displacement and surface payroll strength stays dormant. If it drops a second consecutive month while payroll headlines hold, the Fed's blind spot becomes a policy problem. One number in early May will tell you which reading was right.